Hi, this video will take you through some of the key content from the Advanced Financial Reporting syllabus. We won't go through the whole syllabus, but we will pick out the areas that are commonly examined in the case study, and we will think about the types of tasks you may face from an F2 perspective. If you sat your F2 objective test recently, this recount will probably be sufficient. If it has been a while, and the topics we discuss here are not so familiar, then you may need to do some more revision in preparation for your exam. Don't forget the case study can test anything, so you need to be prepared. The first syllabus area we are going to have a look at is long-term finance. We are not yet thinking about how things are accounted for. This is a more strategic section of the syllabus, which may be tied up with E2 and P2 in the exam. So the business may be thinking about a new venture. From an E2 perspective, you may need to think about the external environment, the competitive environment, and whether the strategy will be accepted by key stakeholders. The P2 aspects may include investment appraisal of this venture, and then you may need to think about how the venture will be financed. The main options when financing a long-term project are equity financing and debt financing. For each source, there are various different examples of how the financing can be achieved. Let's start with equity financing. This is the finance provided by the ordinary shareholders. One easy approach is to use the retained earnings of the business to fund future projects. Even if the company has large amounts of retained earnings though, this doesn't necessarily mean that cash is available. So it is important to consider the available cash balance, as well as whether a dividend can be cut to retain cash in the business for investment purposes. If this is not possible, then the company could do a rights issue to raise equity finance. This involves offering the existing shareholders new shares in proportion to their current shareholding, at a discount to the current share price. This will only be successful if the shareholders are willing and able to invest more cash in the business. If this does not seem likely, then the company can do a new issue of shares to different investors. One of the main downsides with all equity finance options is that it can be quite expensive. As shareholders are not guaranteed a dividend, their investment is quite risky, and this risk needs to be compensated with a higher return. If this is not appropriate, debt financing may be raised. There are various options here, including a simple bank loan or issuing debentures, which are basically traded blocks of debt. Debt finance is generally cheaper than equity, as it is considered less risky, and also benefits from tax relief on interest, which is not available on dividends paid out. Other forms of long-term finance include leasing and government grants, if available. In P2, we look at investment appraisal, and in particular calculating a net present value for a project. To determine the net present value, we need to discount the future cash flows at a suitable cost of capital. For many projects, this cost of capital will be the weighted average cost of capital, the WACC. This assumes that the investment will be financed from a pool of funds, and so an average cost of those funds is determined. Cost of equity can be calculated using the dividend valuation model, or the capital asset pricing model. The cost of debt depends on whether the debt is redeemable or irredeemable. For irredeemable debt, we will just take the interest rate less the tax relief and divide it by the market value. For redeemable debt, we need to calculate an IRR. If the debt is a simple bank loan, a loan with a rate of 5% will have a cost of 5% less the appropriate tax rate. The weighted average is then calculated according to the relative market values of each form of finance. You may need to comment on the difficulties associated with the WACC, or think about some of the limitations of using such an approach. So what might the questions ask you on this area? You could be dealing with an entity who wishes to raise finance. So you need to discuss some of the different methods, different types of equity and different types of debt finance. Compare them, thinking about the pros and cons, and then making a suitable recommendation. You may need to think about the appropriate cost of capital. What would happen if the share price changes? What does the weighted average cost of capital actually represent? And when and how can it be used? And if you have an unlisted entity, you may need to think about alternative methods of raising finance. You may also need to think about what the finance is being used for, and therefore what the most suitable approach would be. Financial reporting is definitely one of the largest areas of the F2 syllabus. Although you are unlikely to get a large amount of marks on this overall, probably no more than 20% in most exams, all of the following accounting standards are potentially examinable, so it is important to ensure that for each standard you know the main rules. Financial instruments are contracts that give rise to both a financial asset in one entity and a financial liability or equity instrument in another entity. Financial assets include cash, receivables, investments in shares, and investments in debt. Financial liabilities include overdrafts, payables, and loans. Equity is the ordinary share capital of the business. Financial assets are always initially recognised at fair value. Subsequently, they may be measured at fair value through the profit and loss, fair value through other comprehensive income, or amortised cost. Fair value through the P&L is an accounting way of recognising volatility in the P&L. We would use this approach if we intend to sell the investment in the short term to make a profit. Fair value through other comprehensive income still recognises some volatility as it reflects changes in fair value, but these don't hit the P&L. Amortised cost is the most stable way of accounting for a financial asset, and so can only be used where there is little volatility in the fair value. For receivables, or where we have lent a company money and will collect all of the interest and capital back on the loan. When finance is raised by a company, we need to determine if it should be accounted for as equity or a liability. The key consideration here is whether an obligation exists or not. If there is an obligation to either pay interest or the capital back, then a liability is recognised. If the finance provider is only entitled to dividends, which may or may not be paid, there is no obligation, and this will be recognised as equity. Once we have determined the finance is a liability, then we will usually use amortised cost to measure the amount in the financial statements. You may also need to think about how convertible debt is accounted for. The money raised from such debt needs to be split into an equity and a debt component. The debt component is the present value of the future cash flows, discounted at the cost of a similar non-convertible instrument. The remaining proceeds will be accounted for as equity. In the exam, you may need to think about ways to motivate staff. This kind of question will use the ideas we have talked about in E2. One method which may be suggested is to offer a share option scheme to employees. This allows the employees to be motivated by the long-term prospects of the company, as they can benefit from increases in the share price. This is an example of an equity-settled share-based payment. These are accounted for using the fair value of the share option at the date the options are granted. This is then spread over the vesting period, and each year an additional amount is recognised as an expense and as equity. The fair value of these instruments will not be remeasured each year end, but you may need to consider changes in the number of options expected to vest, as this will change the amount recognised. A cash-settled scheme is basically just a bonus scheme, where the amount of bonus will be based on changes in the company's share price. As this is an amount paid out in cash, and is therefore an obligation, this will be recognised as a liability, and therefore remeasured each year end according to changes in the share price. Companies will disclose an earnings per share figure, if they are listed, in the notes to the accounts. This shows investors how the business has improved their individual wealth since the previous year. You learned how to calculate this, along with all of the complications involved regarding rights and bonus issues, in F2. You may have to explain how the calculations work in the exam, even if you don't actually have to do them. You may also have to discuss diluted earnings per share. This is an additional figure a company may need to disclose if they have taken any action which may result in new shares being issued in the future, which could dilute the earnings per share. Normal share issues at full market value aren't included in this. But if the company has issued some share options, then the number of shares may increase in the future without a corresponding increase in earnings. This will reduce or dilute the earnings per share. The main dilutive actions a company may take are to issue share options or to raise finance using convertible debt. As I mentioned earlier, leases are a way of financing an investment in new assets. You may have to discuss this as a source of finance and then explain how a lease would impact the financial statements. The first thing to decide is whether the lease is a finance lease or an operating lease. The definition of an operating lease is a lease that is not a finance lease. So that's easy enough. But how do we determine if it is a finance lease? The key thing to think about here is risks and rewards. If the risks and rewards of ownership have been transferred to the lessee, then they will account for a finance lease. There are many indicators of whether risks and rewards have transferred. If the lessee will be responsible for insurance and maintenance, then they will be taking on some of the risks. If the present value of the minimum lease payments, so basically what they are paying, is substantially all of the fair value of the asset, they have suffered a risk of ownership, having to pay for the asset. If the lease is for most of the asset's useful life, they have a reward of ownership, as they will get most of the use of the asset. All of these indicators need to be considered before applying judgment in determining if a finance lease exists. It is important to correctly classify a lease, as the accounting treatment is quite different. If we are accounting for an operating lease, we don't show the actual asset on the statement of financial position. Instead, we show an expense in the profit and loss. This is calculated as the total amount paid for the lease spread over the life of the lease. The only amounts appearing in the statement of financial position will be if there is a prepayment or accrual of the lease costs at the year end. Accounting for a finance lease is more complicated. The company must recognise the asset and a corresponding liability. The asset will be depreciated and the lease will be measured at amortised cost. So a finance cost will be charged to the P&L each year, and then cash payments deducted to arrive at the year-end liability. This will then need to be split between current and non-current liabilities. Determining whether a lease is a finance lease or an operating lease will therefore have a significant impact on key accounting ratios, something you may be asked about in the exam. All businesses will generate revenue, and therefore we always need to consider whether the revenue has been recognised appropriately. The basic principle, as we can see here, comes straight from the conceptual framework, and that is that revenue is recognised when it is probable that economic benefit will flow to the entity, and the benefits and associated costs can be measured reliably. We then need to consider whether the revenue is for goods or for services. Revenue for goods will be recognised when risks and rewards and control of the goods pass over to the buyer. This will usually be when the goods are dispatched or delivered to the customer. Revenue for services needs to be recognised according to stage of completion. So if a training company is recognising revenue for a course which takes place over 6 months, it will recognise revenue as a proportion of the total course fee spread over the days of the course. You may need to consider accounting for a provision, contingent liability, or contingent asset in the exam. Indeed, you may need to identify that these exist and haven't been recognised appropriately. So what are the main rules? It all comes down to likelihood. If we are trying to decide what to do with a potential liability, and that liability is virtually certain, then we would recognise it as a normal liability. This would usually mean we know the exact amount and timing of the required payment. Consider a legal case. If we've been taken to court and lost, and the court has told us what we need to pay and when, this is virtually certain and would be recognised as a normal payable. If payment is only probable, so more likely than not, then we would recognise a provision. In this case, we may not know the exact amount or timing. So if, for example, it looks like we will probably lose the court case, but it hasn't yet been decided. If it is only considered possible that we will lose, then we won't include any form of obligation in our statement of financial position. We will, however, disclose the situation as a note to the accounts. If the chance of losing the case is remote, we will ignore it entirely in our financial statements, including the notes. You need to be very careful when stating that a liability should be recognised. Make sure that the entity has an obligation to pay. A common issue is where the company wants to provide for future operating losses. This is generally not allowed, as there is no obligation to incur losses. The company could just cease to trade and generate no further losses. The situation is different if we are looking at a possible receipt in the future. So imagine we are suing another company for damages. We will only recognise this if it is virtually certain, so if the case has already been won. If it is only probable that we will win, we will only disclose this fact in the notes to the accounts, and any other likelihood will be ignored. You may have to think about where the tax expense in the financial statements has come from, and why it is usually not just the tax rate multiplied by the profit before tax, or not the same as the tax figure in the corporation tax computation. One reason for this is that the tax expense may include movements in deferred tax. Deferred tax is an accounting adjustment which aims to match up the profits accounted for with their tax implications. It is therefore concerned with areas where there is a difference between the tax treatment and the accounting treatment, as long as that difference is only temporary. One relatively simple example of this is depreciation. This may be charged at, say, a 20% straight line basis in the financial statements, whereas the taxman may give relief in the form of writing down allowances, at a standard rate of 25% reducing balance. This will produce a difference each year until the asset is sold, when the difference will be removed through a balancing allowance or balancing charge. The accounting rules on deferred tax take a statement of financial position approach. So we will compare the carrying value of an asset or liability in the statement of financial position with the taxman's asset or liability. If the carrying value of the net asset is higher than the taxman's tax base, then a deferred tax liability will arise. If the tax base is higher than the net asset, then a deferred tax asset will arise. Assuming the tax relief, which gives rise to the asset, is considered probable. When you studied F2, it is likely that you focused on the mechanics of calculating figures required for consolidated accounts. So, for example, the statement of financial position, here you will probably have learned 5 standard workings. This is not really what you need to know for the case study exam, as you will not be preparing a consolidation. Instead, you may have to explain consolidation to someone, in which case an understanding of the underlying principles will be important. The first principle to appreciate is that consolidation starts with an entity having control over another entity, a parent having control over a subsidiary. This may arise as they own more than half the shares, or maybe control the seats on the board. If an entity, a subsidiary, is controlled, then it is part of the parent company's group. When we prepare accounts from the group's perspective, the consolidated accounts, we consider this to be one entity. We include all of the assets and liabilities of the subsidiary on a line-by-line basis. Only the share capital of the parent and the parent share of the subsidiary's post-acquisition reserves. In the consolidated profit and loss, we will include all of the subsidiary's income and expenses in determining the group profit after tax. Once these basics have been dealt with, there will be some consolidation adjustments required. Intercompany transactions and balances will need to be removed. Any profit from such transactions still included in inventory, as the goods sold intercompany have not yet been sold outside of the group, will need to be removed. All of the subsidiary's assets and liabilities will be included at fair value, and so fair value adjustments may be required. A non-controlling interest will be required in both the statement of financial position and the profit and loss, assuming the subsidiary is not 100% owned by the parent. This will reflect the share of net assets and profits not owned by the group, even though all of the net assets and profit are controlled by the group. You may also need to consider foreign currency in the consolidation, if one or more of the subsidiaries prepare their own accounts in a different currency. An appropriate rate will need to be used to convert these financial statements. Closing rate for the assets and liabilities, and average rate for income and expenses. A foreign exchange profit or loss may arise each year, and this is recognised as a separate component of equity and in other comprehensive income. If a group already exists, you may need to explain how an acquisition or disposal will be reflected. There are several possible scenarios here: full acquisition, step acquisition, full disposal, and disposal of shares whilst retaining control. Make sure you know the basics of accounting for each scenario so you can explain it. You also need to ensure you can explain the impact an associate will have on the financial statements. Unlike a subsidiary, only the parent share of assets, liabilities, income and expenses will be included for an associate. Also, unlike a sub, this will be shown as a single line in the Statement of Financial Position and also in the P&L. Most financial reporting requirements will focus on you explaining a particular accounting treatment to someone with less understanding. Here are just some of the possibilities. You may have to think about financial instruments and consider the impact on financial statements of raising finance by issuing some debt or issuing some shares. You may have to think about how investing in a financial asset would impact the financial statements. You also need to bear in mind that if you have invested in a financial asset, one way of doing this is to buy some shares in a company. A significant investment in shares could result in an associate, a subsidiary, or a joint venture. You may need to explain what the impact will be on the financial statements of entering into a lease agreement. So first discuss what kind of lease you have identified and then talk about how it will be accounted for. You may then have to comment on how the financial ratios will be affected by entering into a lease and possibly how the financial ratios will differ depending on whether the lease is an operating lease or a financial lease. You may need to consider whether an arrangement contains a lease. Moving on to consolidation, you might need to think about how an investment in a company would be reflected in group financial statements. Would it be an associate? Would it be a subsidiary? Would it be a joint venture? Would it be a full acquisition? Would it be a step acquisition? You also may need to think about how either a full disposal, where the group loses control, or a partial disposal of the shares, where the group retains control, may impact the financial statements of the group. You might need to advise on how goodwill is valued. And you might need to think about the impact of changes in the exchange rate on financial statements. In addition to the impact of foreign exchange on consolidated accounts, you may also have to talk about how accounting for individual transactions works when those transactions are denominated in a foreign currency. You may need to explain how to deal with the foreign subsidiary in consolidation. You may be dealing with a company that is suggesting having a share-based payment scheme for the first time. How might that impact the financial statements? What might the difficulties be associated with applying a particular accounting treatment? You may also have a question on revenue recognition. There may be a new customer contract in the scenario, and you have to explain how the revenue will be recognised. You may find the director suggesting a particularly aggressive way of recognising revenue, where they try to accelerate how much revenue is being recognised. As well as talking about the accounting treatment here, you can also comment on whether this is ethical or not. You may have to deal with an uncertain event and how it's been accounted for, and whether a provision should be made. And you might have to think about whether a company is applying or suggesting some kind of creative accounting, maybe to smooth their profits from year to year. Again, this would be linked to ethics. The final syllabus area from F2 is analysis of the financial statements. You will usually be provided with financial statements in the pre-seen information, and you should apply these analysis techniques to gain a better understanding of the entity. You may also have to think about how a particular strategy or situation in the exam will impact the ratios you have calculated. So it is important to have a good understanding of how to analyse the performance and position. A good starting point for analysing the performance of the entity is return on capital employed. This looks at how well the business is generating profits from the capital invested. We would generally use the profit before interest and tax. And capital employed is all of the share capital and reserves, so all of the equity, as well as long-term debt. Trying to analyse this figure on its own can be quite difficult. It is often easier if we break it down into its component parts. A neat trick is to use a bit of maths, which shows us that return on capital employed is equal to the operating profit margin multiplied by asset utilisation, or asset turnover. We now have two ratios to explain, which are much more useful. Asset utilisation tells us how well the business generates revenue from the capital employed. This may be lower if the capital invested is in old, tired assets which aren't very efficient. It may also be low, simply to do with timing. If a company buys some brand new assets at the end of the year, the capital employed will be high. But these assets won't yet have had a chance to generate more revenue for the business by the end of the year, and so asset turnover, or utilisation, will be lower. Asset utilisation can also be affected by inefficient working practices, such as lack of machine maintenance, or could even be affected by external factors such as increasing competitive pressure, affecting the amount of revenue which is generated. Operating margin, operating profit percentage, then considers how much of this revenue is converted to operating profit. This will be affected by the prices which can be charged for the products, depending on the customers and the competition. It will also be impacted by changes in the cost of raw materials, possibly due to bulk buying as the business grows, or negotiations with a new supplier. Do be careful though. If the only change that has taken place is an increase in sales volume, and this hasn't led to economies of scale, then there will be no change in the operating margin percentage, as the revenue and costs will both be impacted. Operating margin will also be affected by changes in admin costs. For example, a new office building will attract higher depreciation that will reduce operating profit margin. Once performance has been analysed, we can think about liquidity, how easy the business finds generating cash. This may involve calculating the current ratio by dividing the current assets by current liabilities, but this can then be analysed further by separately considering inventory, receivables and payables. Inventory days tells us the length of time it takes from buying goods to selling them. Receivables days tells us how long it takes us to collect the cash from our customers. And payables days tells us the time taken by us to pay our suppliers. Overall, this can show us how liquid the business is. For example, if it takes 40 days to sell the inventory, 40 days to collect the cash, and we are paying our suppliers within 20 days, we are not going to be particularly liquid. Once we've looked at the performance and liquidity of the company, we can think about the long-term financing or capital structure. This considers the impact of having more or less debt compared to equity. High levels of debt mean our gearing is high, and we could be under pressure in terms of finding the cash to pay interest. This can be considered risky, and investors will often start to get concerned if gearing increases too much. Another way to think about the impact of higher gearing is to look at the interest cover. This calculates how many times the profit before interest could pay or cover the finance cost. The higher this figure is, the lower the risk of the company defaulting on interest payments. So in addition to using the ratios in your analysis work, you may have to discuss some of these issues in the exam. It may tie into a particular accounting treatment, and you may need to think about how that accounting treatment, so for example, as we mentioned before, the choice of lease, or possibly whether something is going to be treated as debt or equity, would affect a key ratio. You may be given some additional financial information in the exam, or even some calculated ratios, and you need to comment on what they might mean for the entity. You might have to compare performance year on year, or between the company and one of its competitors, or maybe even a target that they are considering acquiring. You may also need to discuss the limitations of this analysis. So, for example, the fact that sometimes it can be difficult to compare like with like. I hope this recap has helped with your understanding of the F2 topics. Make sure you have reviewed the material and covered all of the accounting standards in the syllabus.